Hello everybody and welcome to Green Star Trading with me Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. It's just coming up on 20 minutes to 10 AM on Saturday the 20th of March 2021 and we're going to spend the next few minutes looking at the US stock market. Now I put out a video a week before last, which was on the US stock markets, where I covered the S&P, the NASDAQ and the Dow, and it was quite well received in terms of the number of likes and the interest it got from my viewers. And I've decided that's the format I'm going to pursue from now on a weekly basis for the US stock markets. Rather than doing individual videos for the S&P, the Dow Jones and the NASDAQ, we're just going to do one weekly roundup and look at all three. This saves me effort and time editing multiple videos and recording multiple videos. But I am going to stick to the single 10 to 15 minute length video for all my other assets that I cover in individual videos. I just think it makes sense to cover the US markets this way. So that's the format going forward, a weekly roundup of the US stock markets in one video, which will be time stamped as I cover the different markets, and then all other assets in their own videos. So let me know what you think about that in the comment section below, if you think that's a good idea or not. Now, without further ado, let's get on with it. We're going to start with our basic technical analysis first and our Elliott Wave analysis second. So we're going to start here with our proxy, the SPY for the S&P 500. Okay, we're on the arithmetic and weekly time frames here. So a quick rundown for the chart in case you're new. So we have our Elliott Wave count, which is all the numbers and letters you see on the chart here. We're just going to hide them out the way for a moment. And then we have 4 exponential moving averages, 10 in yellow, 20 in blue, 60 in orange, and 250 in green. We have a volume profile on the right hand side here, showing the peak of the buy and sell volume and all the other various peaks. We have a built-in point of control here, which is a yellow dashed line, which is the peak of the buy and sell volume. We have an RSI set to a 10 close with a green 30 level representing oversold and a red 70 level representing overbought. We have a MACD with a 10 for the short term moving average, a 20 for the long and a 9 to smooth. Right then, so for the last week what we can see, inside candle, not particularly bearish, still trading within the previous week. Let's just zoom in and have a look. Yeah, so we did make a new high during the week and then we reversed from it, but it wasn't a violent reversal. We didn't come down to gobble up the previous week's price action. We're still trading inside of the body of the previous week's candle, having made that high, and we've settled roughly off of the lows of the week, but more further down from the highs of the week and closer to the lows for the week, but off of them on the Friday close. So not extremely bearish, could be the start of a greater downturn, but we need future confirmation in another bearish candle or two after this. So can't read too much into that at the moment. Still trading above the 10, the 20, the 60 and the 250 exponential moving averages here on the weekly time frame. Now on the RSI, we can see that we have come up to overbought conditions around the week of the 4th of January, reached overbought conditions, and then we've set a series of lower highs in the RSI while we've set a series of higher highs in price. This is what we call bearish divergence. It's a ongoing feature of the market. Even during this huge bullish move up, we've been continuing to build these bearish divergences. We have still yet to reach the peak of the momentum in the RSI, which was set on the week of the 24th of August back here, where momentum peaked but has since dwindled downwards while prices continued higher. This fits my Elliott Wave count that this is the top of the wave 3, where we would expect to see momentum to peak in the RSI, and it seems to have done so. Right then, MACD, what can we see here? Well, we're going to need to just zoom in here on the MACD a bit, stretch it out a little bit. So we can see how on the shorter time frame, from the high back here on the 16th of February, we can see a high here in the MACD. We then had a bearish crossover of the short term, the blue moving average, over the longer term orange moving average here, the 10 over the 20. We have recently bounced back up to a new high here, setting a high for the week of the 15th of March last week, and yet did not get a bullish move back above on the weekly time frame. So quite a strong divergence here in the short time frame between the high of the 16th of February and the high of the 15th of March here, of those respective weeks, where we can see a crossover in the moving averages on the MACD, and we can see bearish divergence between the two highs on the RSI. So pretty weak punch to new highs on the S&P. Very indifferent. Very indifferent price action regarding how different it is to the Dow Jones, which is a very violent and aggressive push to new highs over the last few weeks. And the NASDAQ, of course, has been selling off. So the big question we're dealing with today, looking at the markets, and I think going forward until we see confirmation one way or the other, is have the US indices diverged from one another? Now, if they have genuinely diverged, and this is the strongest divergence we've seen since the run-up of March 2020 and the bottom, this is the strongest prolonged divergence in price action we've seen, with one index going one way and another one going the other way. This could signify the top, potentially, where the NASDAQ peaked first, it rallied fastest, it rallied highest and strongest, and first it would make sense to peak first, with the S&P then following suit, and then finally the Dow. Now, this would help accommodate the fundamental view of a rotation in equities from tech stocks to value stocks and to finance and so on and so forth, and industry, the idea of the economy switching back on. So obviously from an Elliott Wave point of view, we would simply view that as one market peaking after the other from a technical perspective, but the fundamentals do support that at the moment, the idea that there will be a sustained move away from overvalued techs. But this could just be a peaking process, one market first, then the next, then the next. So, okay, and of course, when we refer to the S&P, we are referring to the collective market. But we're looking at the narrowest, and the broadest, and the most overvalued in the NASDAQ. So, let's come down to the daily time frame. Carry on our basic analysis here on the SPY. So we can see here we are closing the week below the 10 exponential moving average, with the body of the candle just rallying up on the Friday to close itself above the 20 exponential. We see this all the time when we look back on these clutch days where we start to have a sell-off. There's a sustained effort to get above that 20 exponential. We just managed it here. Still above the 60 and the 250s miles away. Right, so what is interesting over this recent period here is when we start to push to new highs, or we start to get overextended, or we push to new highs, what's quite normal to see is that the volume profile, instead of building in peaks, excuse me one moment, I have not got time to talk to you, phone is now on silent, there we go. Right then, so as I was saying, we're above the 20, we're below the 10, we're above the 60, above the 250, and I was talking about how we can see an increase in the height of these peaks in the volume profile here. And volume seems to be reaching a climax, or increasing as we head towards the peak. This is also kind of synonymous with reaching the top, where we have a climax of both price and volume together. We'll have to wait and see how this plays out, but can't read too much into this at the moment. Yes, we've come down in the last few days, but we're still settling above these major moving averages. That divergence I spoke about on the daily time frame, perhaps you can see it a bit more clearly here. I mean, if we go all the way back to the 2nd of September, this high here on the RSI, which is all the way up at around 86, we can see how now the RSI comparatively is around 65, considerably lower, out of overbought territory, I should say, and yet the price has gone way higher in that time, and we have a divergence between these two highs here, and in the more recent time frame between the high on the 16th of February here and the high we just set. So we keep seeing these divergences build in the markets. Same is there in the MACD. We can see on the daily time frame, momentum in the MACD peaked back here on what we can see on the chart on the 2nd of September, and we've just set a series of lower highs since, as the prices continued higher. So this whole time, as I've been saying for weeks now, we keep pushing highs on weaker and weaker, with the market being weaker and weaker in momentum terms, we continue to push highs. So very synonymous with that fifth and final move up in the market, where it makes it on bad momentum. It pushes a new high on bad momentum, and we've got the conditions for that. We've got extreme speculation, extreme retail trader involvement, and declining momentum and divergence in momentum and price all at the same time. So, and we've got a count which supports it as well. Right then, so that's the basic analysis done on the S&P. So we'll bring the count up here, and then before we do the Elliott Wave analysis here, we will go over and do the NASDAQ, and we will clear the chart here and we'll look at the NASDAQ. So weekly time frame, basic analysis of the NASDAQ. Obviously a much more sustained and vigorous sell-off than we've seen in the Dow Jones or in the S&P over the last few weeks, closing the week below the 10 exponential average, but touching down on the Friday just to give the 20 exponential average a kiss. As you can see here, we bodied the candle above the 20 the week prior, and we bodied the candle the week above the 20 on the week prior to that one. And this is obviously providing very strong support at the moment. We can see back here on the 20th of November and on the 26th of October, those 2 weeks we came down to test the 20, and we're doing that now. We are wicking through it more violently than we did there, but we are absolutely bloody determined to keep the body of the candle above it. That is the trend at the moment. So if this breaks, it would be a very significant sign of further momentum to the downside, I think. Now, on that note, the same divergence which you can see in the S&P is present here in the NASDAQ as well, especially on the weekly time frame here. We can look from the week of the 24th of August with a height of 81 on the RSI, all the way down to a more recent high, still in overbought conditions around 72 on the RSI on the week of the 8th of Feb, or 15th of Feb. So big divergence in price and RSI again. Same with the peaks in the MACD here, with the momentum peaking in what I think is the wave 3 on the week of the 31st of August, and then coming down to a lower high in the RSI on the 15th, on the week of the 15th of Feb, which we can also see here, lower on the MACD, high in the MACD, lower high in the MACD, high and higher high in price. Crossover of the short and long-term bearish, short and long-term moving averages here, bearish crossover, with an increase of bearish momentum to the downside, a bunch of red bars on the histogram here, seemingly getting stronger, even though we've had a green bounce. We put in the low on the second bar here on the histogram. If I just zoom in to the more recent price action so I can explain what I mean. So you can see how here we bottomed on the week of the 1st of March, which was our second bar on the histogram, and even though we've bounced, put in a green week and finished higher in the 2 subsequent weeks, the bearish momentum has continued to build as we recorded darker and bigger bars on the histogram. So we're not necessarily done yet in this sell-off, which points towards the idea that we might be witnessing some kind of divergence between the indices. So let's just come down to the daily time frame and see what we can see here. Now on the daily time frame, we are below the 10 exponential moving average, we're below the 20 exponential moving average, and we're below the 60 now. Price has come up, pushed its way back above the 10, the 20 and the 60, and then being rejected. It's quite a strong sell-off on the Thursday, and finished the week below all the major moving averages bar the 250. Now we can see how we've had this bounce on the weekly time, on the daily time frame here on the MACD, with a bullish crossover here of a short-term time frame over the long-term time frame, but the momentum in that bounce already appears to be dying out. We had a little rush up here. Unlike the sustained bearish momentum which brought us down here on the weekly time frame, is still being expressed even with this bounce. On the daily time frame, we had that crossover, some bullish momentum occur, and then start to die off, and the darker green bars appear and move back into neutral territory on the RSI. Now, when we come to look at this with our Elliott Wave count, interesting where we've come to. I said in the previous video that I was waiting for a 61.8% to 65% retracement of price off of the low in the NASDAQ before considering selling. Now I also went long that previous week off of the low when we saw the bullish count not getting validated, and had to give the bulls the benefit of the doubt that having protected the top of wave 1 and not getting the wave 4 invalidation, that we had to consider a bounce was definitely on the card. So got in long, reached to 61.8%, which I'll show you later, and I'm now temporarily, just temporarily short again, waiting for some confirmation. So yeah, very different from the one we're now going to go over and look at, which is the Dow Jones weekly time frame here. Different count on the Dow, but we'll worry about that later. I'll save that to last because it's completely different. Now, if you just excuse me for a moment, I'm just going to have a sip of my coffee. That's better. It's not really a mug, it's more of a bucket with a handle attached to it, that one. Need both hands to use that thing. Anyway, but it keeps me going, that's what's important. Right, so on the Dow Jones here on the weekly time frame, just a completely different story from the NASDAQ. Basically, the inverse of it. We have a push to new highs on a strong green bar for the week of the 8th of March. And then the last 2 weeks we've been topping out very little price movement. How it appears above the 10, the 20, 60, 250 exponential moving averages. Now, different on the Dow here. A broader market of all 500 US stocks of the biggest companies in the US, the S&P is showing a divergence on the shorter time frame here, on the weekly time frame, and from the high back here on the 24th of August. But the opposite is true here on the Dow. We do not have that divergence in price and RSI. In fact, the RSI actually supports the price. Now, we are back into overbought territory here with a high which is above the previous high in price, but equal in RSI. That's not bearish divergence, but it's not exactly really supportive of the bullish move either. It's more of a case of it's just a bit flat here in overbought territory, but stronger, considerably stronger than it is in the S&P and the NASDAQ especially, which we all, well, not all of us, but most of us would agree is overvalued. So we see here in the MACD as well a high, and then an equal high rather than a higher high, but not a lower high. So MACD supports this move up in the Dow, as does the RSI. So it does support the idea that if we were to see divergence in the peaking process of this long-term bull market, it might take a few weeks and a few months yet. We may have higher highs to come. Especially here, we may have higher highs to come. So, but it might be a case that we are seeing the initial signs of that breakdown where the markets are beginning to diverge. One market showing considerable weakness, having been extremely overbought and is losing momentum, is breaking down, and another one still pushing out the highs. So let's come down to the daily time frame, see how it looks here. Now on the daily time frame, let's just switch back into arithmetic here. So still above the 10, still above the 20, still above the 60, still above the 250. Visited overbought conditions on the RSI during last week, have now cooled off a bit, not quite back in the neutral territory. We do have quite an interesting case here with the MACD where momentum's been dying off as we've topped out. We've got a series of darker green bars on the histogram here. The blue shorter term 10 moving average is close to crossing over the 20, getting a bearish sell signal here. Not yet. We're still on the 10 exponential average. We closed a week above it. We could bounce and we haven't crossed yet, so we've got to be patient for the bears. But a breakdown through the 10 and the 20, crossover here on the MACD, supported by a move lower in the RSI, would all be potential sign that we put in a significant top up here. Then we'd be looking to see what we retrace since the low of the 4th of March. Right, so this I think is enough. That concludes our basic technical analysis. So let's start our Elliott Wave analysis, and let's go back to the S&P where we've got our count up and talk about the Elliott Wave picture. So we were focused on this area here in the previous video. Now let's come down to the 2-hour or to the chart, and I'll show you what I've had to change here to make things fit. We'll look at the bigger picture as well in a minute. So essentially I've had to count what I was trying to work as a impulse wave down to here potentially, is now we have to count this as an A, B, C into an intermediate wave 4. So I've had to adjust the count basically up a notch in terms of wave degree to include this intermediate wave 3 and 4 here. And now we're in a wave 5, and we have either peaked and it's the 5th of the 5th of the 5th of the 5th, or this is simply a 1, 2, 3, 4, 5 to go higher. Well, I've got the 1, 2 as the 2 big bars back here, so if we just come down to the hourly time frame, because we had the low on the 4th of March and then we had an initial move up and a pullback which concluded with a higher low. So this is our 1, 2. And then I'm saying a 3, 4, 5, or we could even say 3 over to here, 4 over to here, and 5 to come and go higher. That's possible. So we're either, once again, I've been saying this for a while now, it feels like we're very, very close to the top. We're very, very close to the top in the S&P, in the overall market. I was wrong here. We had this sell-off in 3 waves. But if this was our wave 3 into our wave 4, then this will be our wave 5. So we've either peaked, or we've got another push up to this trend line, which is the long-term trend line taken from the wave 1 and the wave 3 to project the 5. So using that traditional relationship between the wave 1, the wave 3 and the wave 5, that would suggest, using a fib channel, if we were to place one here, that we have got one more move up to find that 5th wave. and finally conclude it. This is as a result of this bearish count being wrong. We have made a new high, which is all we need to do to complete a wave 5, but it's only just a new high, so still giving the bulls the benefit of the doubt, having defended their count, having defended the bullish count, that it's likely we're going to push higher, I think. Now, it's also possible that if we just zoom into the shorter time frame here, we have got a structure here where we have a higher high on the 17th of March, and then which is higher than the high back here on the 16th, and then we have what could be the start of a 5-wave structure. 1, 2, 3, 4, 5. So if we were to see this go lower on the Monday and the Tuesday, then we will have to consider this to either be an A leg down into a 3-wave move, or a wave 1 down. So that would cancel out the 3-4 idea for the moment. So we'd have to adjust that. But if we were to see another move down and have 5 waves complete, then the only way we're going to really be able to count this is either as an A with a B to come and a C, and then we'd have to say, well, we need to reconsider this whole count at that point. What we're looking at, are we looking at a 1 here, and then a 2, and much higher highs to come? Or is this the top of the market's in, right, and this has gone leading diagonal into a 1, 2, let me just show you what I'm thinking here. So we go 1, 2, 3 to come next week, 4, 5, down into a wave 1. So shorter term, I'm just putting up another impulse wave. Why am I doing that? Right then, so shorter term, let's just create this in yellow and put this in something to, let's delete this primary count for the moment, it's confusing me. Let's just focus on the price action at the high here. So we've got a double top. We're saying 1, 2, 3, 4, 5 diagonal into a wave 1, and then A, B, C into a wave 2, and then a 1, 2, 3, 4, expecting 5 waves down into a 3, and then into a 4. I'm going to change this to minute, sorry, and this to minuet and minor, minuet and minute. So there you go. Now, otherwise, I would say that you could count this simply as an ABC. So you go A to here, B to here, 5 waves down in a C, and then you're done. So that would support the idea that this is a 1, 2, this is a 3, you've got your 4 to come, above this wave 1, another deep 4, we've seen a few of those lately, haven't we? And then a very deep 4 we saw in the NASDAQ, assuming the bulls are correct. So there's your two options. I'm just going to leave that on there, save that for my own interest at the moment, that we've either taken it, we've made a new high in the S&P, and it's either the 5th of a 5th of a 5th of a 5th, and we're done, and that's the bull market over, or we're just doing an A, B, C into a wave 3, 4, looking for another final 5th wave push all the way up. So essentially the high we've just made is going to determine that. If we break back through this high, then obviously we're coming up, we'll see we'll see an A, B, C 3-wave move down, and then we'll start to see 5 waves coming out of the bottom here to make that 5th and final move up. If we fail before the high at 398 spot 13 and come back down to take out whatever low we put in here, then the bearish count, because takes precedent, and we'd be looking for a confirmation of that by breaking the wave 1 high here at 380 spot 62. If we came down below that level, you can be bearish again. If we come down and take out the previous pivot, which is the wave 4, and then we can be very bearish as 371 spot 77. So that's how I see things in the S&P at the moment. If we just zoom out and refresh our minds of the broader count here for the moment. So more recent price action, we can see that we've been building this wedge shape here. Now this trend of the 1 to the 3 to the 5 that I got predicted here, we may have peaked like we're just discussing, or we may have one more move up, but we've been expanding as we've been going up. Now, it's very tempting to count this, therefore, as an ending diagonal because there is potential for overlaps in the count here, and an expanding ending diagonal, very kind of lackadaisical price action, does support the idea of an ending diagonal. But I've managed to count this as an impulse wave, so I'm just sticking with that for the moment because I have my wave 3, 4 primary back here, and then I've got this structure to complete. You know, not pretty. Thrust up in the 1, 2 to find the bottom of this channel, 3, 4, 5 to come. Now, like I said, it's not particularly pretty, but there's no overlap. There's no overlap between the 1 and the 4 on any time degree. You know, I've got no problem putting an impulse wave in here. Minor wave 1 top here, minor wave 4 over here, no problem. Minute time frame inside of the minor 3. Here's the top of the minor 1, here's the bottom of the minor 4, no overlap. Same again on the intermediate time frame, top of the intermediate time 1, here's the bottom of the intermediate wave 4, no overlap. So I don't know how, apparently it's not a very popular idea at the moment, but I've managed to get an impulse wave in here to explain this price move up into the 5th. So there you go. Right, let's come over and have a look at the NASDAQ now. We're going to bring the count up and have a look at this. Right, now, I pointed out after making the low into what I am presuming to be a wave 1 down, this is the bearish count. This supports the idea that the markets have diverged. Okay, so the NASDAQ has topped in the 5th wave complete, bull market's over, and now it's bear market time going from here, excuse me. So, tell you what, let's just hide the let's just hide the moving averages for a moment so we can see a little more clearly. So, we're saying 5 waves down into a 1. Like this. 1, 2, 3, 4, 5. Let's come down to the 1 hour. Or to the chart. Alright, so 5 waves move down. No overlap in the 4. So, legitimate impulse wave here. So, if we're a bear, we have to count this as an impulse wave into a 1, which means that this is going to be one of two things. This is either, if we're the bearish case, we've either put in an A wave and now working on a B with a C to come for a retracement into a 2, or we've already retraced a 2. So let's just have a quick look at our Fibonacci retracement. So we know what we're looking for. We're looking for the yellow zone, 61.8 to 65% retracement. If we just look at where we've come to, we can see that's exactly where we've come to in price. We came down to the bottom, we've worked our way up, we've come straight into the yellow zone, 61.8, 65. Not quite making the bottom of the channel, which had contained all of that previous price data. So I would have, but that's where the 61.65 is. So that's just that. You know, if we look at it in log scale, basically the same. You could argue that we've gone 5 waves up here into an A. If I just show you what I mean, so 1, 2, 3, 4, 5, and now we're going A, B, C, and then 1, 2, 3, 4, 5, somewhere up to touch the bottom of the channel, and then break down in a 2. But the point is, we've done enough, right? We've already done enough to call this a wave 2. My count is for an ABC higher, but that's because I like the idea of a double top in the NASDAQ, because my opinion is that all dips get brought violently, and the last dip would get brought violently as well. Because why wouldn't it? I guess you could argue that the rotation fundamental argument cancels that out as tech loses interest for people. But when I look at some of the tech counts like Amazon and Google, Facebook, I see the potential for a completion of a 4th wave and 1/5 higher wave to come, and that would support the idea of the NASDAQ rallying up again back towards its highs, which would support my idea of a double top. So on that basis, I'd be saying A to C parity. So if this is the A, we haven't put the B in yet, so let's take it from where we currently are. A 100% extension would bring us not up to the top, but very close to it, would give us that double top pattern before selling off. It would also test the bottom of this channel and then get rejected. So that's one way of looking at the bearish count. The next way of looking at it, and we will cover the bullish count as well, the next way of looking at the bearish count is that we've gone A to here, B to here, and C to here. Let's just put that in orange so we know it's different. So A, B, C. Now you can do this because you've got a move here and an A, move here, 3 wave move here and a B, and you can go 1, 2, 3, 4, 5 into a C. and then you can say wave 2 complete. So once I saw, even though I suspect, this is why I said I'm only short temporarily. I got in here once I saw the wave 1 top hold, which you can see in the previous video I discussed that, and then we've moved up off of the low. We came to the yellow zone 61.8, 65. This is where I just wanted to hold my long until, because this is where I was expecting a reaction. You're going to always get a reaction at the yellow zone, and we do. And we immediately moved down off of those levels. So I flipped short off of the rebound, and now we're looking for 5 waves down. Don't think it's done yet. 1, 2, 3, 4. One more move down for that B, and then up to find that C. Now at this point though, we could continue to break down because this could be the wave 2. So this is still a valid short in my opinion from a retracement trader's point of view. We've found the yellow zone, we've retraced. All we do now is have our stop just beyond the high at 13,292 spot 0. 13,292 represents the 65 fib, 61.8, 65 fib area, and if we come back up and invalidate that, we're moving higher, and then you're out of your short and we're back long again, pushing up towards either new highs or to just fail before them and then start heading down again. So that's it. The most pivotal levels here on the NASDAQ are the low at 12,202 spot 25. We know that represents invalidation of the bullish count in terms of wave 4 invalidation of the wave 1. And we also know, taking out the most recent low here after retracing, that we'd have to really count this as a 1, 2, beginning of a 3. So we'd then be coming down much more violently. So there you go. Right, so I don't think if you got I don't think you can be long below this level at the moment at 12,202, because the least path of resistance is to the downside at that point. 1, 2, 3, 4, 5 down, invalidating the bullish count on the longer time frame, taking out this low, having seen a 5 wave down, 3 wave move up into a wave 2 potential retracement at 61.8. You can't really be long below 12,202 in the shorter time frame, because I think we're just going to come down from there. However, the same is true on the opposite side here. If you're short, as I am in a small position at the moment, having flipped short since the 61.8% retracement, you can't maintain your short position above 13,292, because taking out this high after clearing the 61.8, we'd see 5 waves, 3 waves, 5 waves, and we're coming up in either a zigzag or the bullish count, which we're just going to discuss now. So if you're a bull, this is how you have to be thinking. You have to see this whole move as an A, B, C. Okay, in which case this is not the 5th of the 5th of the 5th, this is a 3 here, intermediate time frame, into a 4, and we have to move that 4 across to here, and then we have to go rejig the count, where we either move a 3 up to here, and we simply have a zigzag A, B, C into the 4, or we have some kind of expanding flat pattern where we've gone A, B to higher, C to lower, and then now we're in the 5th and final move up as well. So A, B, C into a 4, and then now you'd have to be counting this as a 1, 2, 3, 4, and off to new highs, and that's that. So that's how I see the NASDAQ at the moment. This bearish count that I presented in the previous video, this is still valid. I haven't changed this. We're still in a bearish mode in the long time frame on the NASDAQ at the moment. We've come down, we've come back up to 61.65, and now we're selling off again. The low we need to take out is the same low we were looking to take out to invalidate the wave 1, which I will just remind you. The bulls have to count this, not my pivot I've got here for my bearish count, at 12,417. We've already invalidated that. This is why I'm bearish. Their wave 1 is this. They're counting this move here. 1, 2, 3, 4, 5, 1, 2. And then the 3 is all the way up to the top there, and the 4 is all the way down to there. So the level we're still looking to take out, and let's just be... This is the futures market, remember. We need to go and look at the NDX, because I think it was that high there. That makes it 12.19, but I'm sure it was 12.20. It was 12.200 I had it as. So, but let's just be precise and say a move below 12.19 for, so 12194 spot 0. I've got it's 12.202, but if we want to be absolutely sure, let's say 12.19. They move below that. Support cancels out the bullish idea that this is a fifth and final wave. Supports my bearish camp that we're heading lower in a wave 3. If that's true and we take out that low, we should expect to see the wave 1 and the 2 of the wave 3 down complete. So we're going to go 1, 2, come down into a 3, 4, 5 of a 1. Then we'd likely come back above that level to find the 2 of the 3. This is designed, obviously, it's not designed, but it's there to see that low get broken, people getting short, and then they get immediately screwed and squeezed by the rebound. And that's why retracement trading, in my opinion, is better than breakout trading, because we're going to wait for 5 waves down, right, of our 1, just as we did here to get short. We waited for 5 waves down. So you go 1, 2, 3, 4, 5. And then we got our 3 wave move, 1, 2, 3 up. We've gotten short and now we're moving again. The same on the smaller time frame, guys. 1, 2, 3, 4, 5, 3 waves up. Get short, off you go again. Don't short the break. I mean, if you want to short the breakout, fine, short the breakout. I don't like shorting breakouts because they tend to be right when they tend to be right when waves of a lesser degree complete, and then you get squeezed. So I much prefer to just wait for 3 waves back and short it. 5 waves down, 3 waves back, wait for the reversal, short it. Same if you're buying. 5 waves up, 3 waves back, buy it, so on and so forth. That's how Elliott Wave traders tend to function as retracement traders. Right then, so that's my take on the NASDAQ. We're looking at that 12.19, 12194. I make it. We'll tell you what. We'll just be certain. We'll go over to the cash market. I'll just save this now. And let's just double check it on the NDX, okay? Because I don't think I've actually saved that. Or did I? Tell you what, let me just have a quick look through my charts. I know this is a long video, guys, and I know I'm waffling a lot. I'm just generally having a chit chat as I go. I prefer this format for these markets because I can just take my time. I'm going to timestamp it anyway, so let's have a look for the NDX. It's got to be saved in one of my... There it is, NASDAQ copy. Got so many charts saved at the moment, I can't always find them all. Yeah, so there you go. I've got it as 12204. Sorry, 12204 on the NDX. If we take that out, what have I got it here as? 12202 as the recent low. So this is the problem with the futures market, isn't it? You see, like I said, futures market's already invalidated it. Cash market didn't invalidate it. Cash market did not invalidate it. We checked it. I know it looks like it did. But it literally got within insanely close. Look, there is a gap. It's right there. It got so close, but it didn't invalidate that count. So the bulls defended their position. But if we take out that 12204, that's it. Bullish count dead. This is the 5, and we're done. And it's 1, 2, 3, 4, 5, and my bearish count is correct. So that's it. We are in no man's land until we do one of those 2 things. We either take out the high here next week at 13.292, in which case we're going to make another push into a wave C, or the start of an enormous wave 3 threatening out, taking out the highs and pushing that 5 up further. If we take out 1202, then we're bearish, big time styly, and we're looking for 5 waves down on the minor time frame, minuet, whatever, and 3 waves back as a retracement, looking for the 50 over 61.8, 65, and then we're in short for the wave 3. If you've already gotten short here on the retracement of the wave 2, as I have, you don't need to worry about that. It would just be an opportunity to add to your short the next time you see 5 and 3, 5 and 3, and then the big 5, big 3, and so on and so forth, all the way down to the 5th wave. And that would just be a wave A, because remember, we're correcting the entire 12-year bull market here. So the first 5 waves down is not the end of it, it's simply the start of it. The end of the beginning. so to speak. Right, now that's enough mumbo jumbo. We've been talking about that for ages. We talked about the divergence, that the S&P has eked out a new high, which could be the high, or could just be a little bit higher to go. The Dow is charging off to new highs and not really giving a shit about what the NASDAQ or the S&P is doing. And the NASDAQ is in bearish mode until we see otherwise. So we have got a genuine divergence to talk about, at least for the short term. So, another sip of coffee. Right then, let's come over and have a look at the Dow. So we've done our fundamental analysis here, so now I'm going to introduce to you a very, very different idea. Now this is just me putting this out there, guys. I've said to you in the previous videos that I'm struggling to make the same count fit for the Dow, and I know I'm being a bit stubborn, because and I'm trying not, honestly I'm trying not to be, I'm trying to be open-minded. I'm just genuinely struggling with it, and we all know why I'm struggling with it. Let's just bring the count up. It's because of this low here. You know, this low invalidates the bullish count for the NASDAQ and the bullish count for the S&P, because they want to count this as a 1, 2. But it validates my bearish count, where I want to count this as a 3, 4. But I then can't make anything afterwards fit. So what I've done is I've gone back and considered something completely different. You know, this is just an idea. I just want to see what you guys think about it. The idea is that this isn't a 1, 2, 3, 4. If we just remind ourselves what I was saying there. So 1, 2, 3, 4, 5. This is not an impulse wave, which is what I'm claiming it is everywhere else. But this whole thing is just an ABC. Yeah, this whole move up is a zigzag, which suggests that the Dow actually topped back in 2020 with the peak here. This is the top. It's like, well, how can that be the top, Tom, if we've gone higher? It's like, well, because this is an expanding pattern. So what I'm saying is this, and like, you feel free to comment. I really actually do want to hear your comments on this. What I'm saying is this, that this is a move down in 3 waves into an A, like this, into the low, into an A, 3 waves into a B, and then 5 waves in a C to come, taking us below where the A began, where the A completed. So it would still accommodate the completion of the bull market and the bear market. It would just mean that technically the bear market in the Dow has been here the whole time. We just can't see it because the price is headed higher. Now, I know that sounds nuts, because people are going to be like, well, how's it a bear market then? Because in my opinion, and we could talk about the arbitrary distinctions being 10% for a correction, 20% for a bear market. To me, that's complete fucking nonsense. It's just bullshit. Price action does not determine it. Impulsive or corrective action does, in my book. If you're in a corrective move, then it's not complete until you complete lower. Right? So even though the market peaked in 2020 and that was the top of the bull market, we've actually gone higher in price, because the wave B is expansive. It's an expanding pattern, an expanding flat. So we come down in 3 waves, we go up higher in 3 waves. We are in a bearish corrective structure, even though the price has gone higher. And then you will see 5 waves down in a C, taking us significantly lower into a devastating bear market. So this is another idea of divergence, which is, rather than the Dow actually diverging now because it's going higher, the Dow was the first to peak and to die. Now, if you think about it, right, industry, supply chains, manufacturing, joblessness, industrial output, GDP, all of that, that's the Dow. Right, because it's not the internet economy, is it? It's not the digital economy. It's the real economy. And there's a strong argument to say that the real economy died when COVID arrived. And that would support the idea that the Dow died in 2020 in February. And that everything since is a bounce into a wave B. Right? everything's is a bounce into a wave B, and the wave C is yet to come. So rather than having diverged by hanging on to the last moment, the Dow actually diverged by being the first to die. But the corrective structure of the B looks like the impulsive structure of the NASDAQ and the S&P, while they continue to push. While the NASDAQ breaks down, they continue to push higher to complete their corrective structure, making us look, or making us believe, that the Dow is actually stronger, when it's actually not. It's actually already dead. It's just waiting, to be buried, so to speak. Now, I know you might be saying, "Oh, what a load of bollocks," and if you are, that's fine. Tell me in the comment section. But have you got any evidence to support this, Tom? Yes, I have. So let's talk about it. First thing we want to talk about is this: if this is a wave A, then there are targets for a wave B. Okay. Yes, there are several, but the first one is for an expanding pattern where we go beyond where the wave A began, is 123.6% of wave A. Okay, so let's just see where we are. Now we're going to switch into log here, and then we'll switch back so we can do a comparison. So let's take the length of our wave A here and come right down to the very bottom. Let's move this C out the way. And let's make sure we're being precise. I'm going to magnetize it. And I'm going to come down to the bottom. And I'm going to magnetize this sucker. And then we're going to zoom out and see where we've come to. Here's the 123.6. Right here, this blue line. And here's the high on Friday. On Thursday. Just wicking to it, or just slightly through it. We've just come to the first potential target for a sell-off for the peak of a wave B. Now, if the NASDAQ has already rolled over and is heading lower, and the Dow is just about to roll over after eking out another high, then this could be it. This could be the fifth of the C of the B. Okay, so that's the first bit of evidence. First target. Now there are two other targets above it. There's the 1318 and the 1618, taking the Dow to 40 grand. Okay, and in which case it doesn't matter if this is a wave B at that point, does it? It will when it finally finishes, but it doesn't matter for any of the bears who called it too early, because you're gonna get annihilated. Okay, so that's beside the point, but we've reached our first target of 123.6. So that's our first piece of evidence. Let's look at our next piece of evidence. The length of the C relative to the A inside of the B wave. So the first instinct overall, when looking at a normal zigzag, or this isn't a zigzag expanding flat, when looking at a zigzag or looking at a flat, we'll often look for A to C parity. However, in this expanding pattern in the wave B can be any combination of corrective structures. Now I've counted it as a zigzag. So our standard relationship of A to C can still be of our targets is still valid. So we're looking at 50%, 61.865 region, and then the typical 100%, which is parity. Doesn't have to happen in an expanding pattern, because we only have to just get beyond where the A began, and that can sometimes lead to either a very short A and a very long C, or it can lead to a very short C and a very long A. So let's just see what we've got. Up to the A, down to our proposed B with the lower low. Here's the 50% to the tick, and we start to sell off. Now, it's confluence. There's no doubt about that. You've got confluence. You've got the overall retracement, 123.6, coinciding absolutely perfectly with the 50% extension of the A for the C. Absolutely spot on. So there's resistance here. Often when we get above previous highs, people like to talk about blue skies, clear skies, nothing overhead, but there's always something overhead. It's called the future, right? And it's just sat out there waiting for you. Alright, now, I'm not saying I can predict it, or anyone can, or tell you what's going to happen, but I can tell you there's something out there waiting, and that it's there at the 23.6 and it's there at the 50. So let's come off log and see if we have any other fib relationships. Now, what we would like to see here is a confluence of other fib relationships, of other fib retracements and projections which sit neatly on top of one another or within the range, right, to help confirm what we've just seen in log. So 123.6, 131.8, 161.8. Let's do it again. Bit there to the very tip. What have we got here? We've got our next target, 131.8 for a B. Literally to the tick. Or just wicking through it, the same as the 123.6 on log. So we've got a log target and an arithmetic target right on top of one another. Right. So let's do our A to C extension again. A. Where are we? We're in the yellow zone. 61.8, 65. Right here. So where we've just topped, and I'm not saying it's the top, we could go high and negate all of this, and it could all be bollocks, right? But where we are currently, with the NASDAQ selling off on the Thursday and Friday after potentially retracing a wave 2, the S&P not having a fucking clue what it's doing, because it's the broad market, it's everything, right? It's going to be the last to give you a clear direction, whereas the narrower markets are going to be more likely to give you some directionality. So just as the NASDAQ selling down into a wave 1 and wave 2 retracement, and the S&P starts to falter, and the Dow Jones pushes to a new high, at that exact same moment we're here at the 61.865, 123.6 and 50 in log, and the 131.8 in arithmetic scale, all up here, all at the same place. I find that quite interesting. Now I've struggled with the Dow until I found this corrective idea, which is the Dow and the industrial side of the economy died in 2020 February, and then ever since everything since has just been corrective movement up before we start a hellish move down. So that's it, guys. I'm going to conclude the video there. I hope you've enjoyed it. I know it's been a lot of waffle, but we really are at a bit of a crossroads. A lot of things will be determined in the weeks to come. A breakdown from here in the Dow from all of these confluent levels would be very compelling to me, but once again we'd be looking for 5 down, 3 back as our first entry point. Before we can consider anything else, we want to see wave structure supporting the price action supporting our wave structure and our Elliott wave analysis. If we get that 5 down, we can look for a retracement, then we can consider our options in the broad account, and that would be our first opportunity to enter short, just as we've done on the NASDAQ. 5 down, 3 back. This could be the start of a wave 3 down. S&P has not given us that opportunity yet. We've put in what could be a double top, but it's a higher high. We've yet to see 5 complete waves down, so I'm still in no man's land on the S&P at the moment yet. The broader market, I'm feeling bearish on the NASDAQ, and I'm just waiting for the rug to be pulled in the Dow Jones. Now, I know that I've stuck my head out on several occasions with these more bearish interpretations, and I've been wrong. But the one thing I do find very compelling, which I'm just going to leave you guys with, is I called a pretty good gap covering trade in the GameStop stock a few weeks ago, and I've often been a fan of gap theory as I've seen it play out over a decade's worth of trading. And we got a big gap to fill on the Dow, which on the day time frame on the DJI has never gotten filled, and it's all the way back down here at 28,504. Now this gap's going to get filled. Okay. It doesn't have to. I accept that, but I think that's the best I'm going to say. I think this gap's going to get filled, and I think if this is the top, or we're getting towards the top, that could be the first move down, just to fill that gap. Then the 2, and then we're on our way down in the 3. So a move to cover this gap, a 5-wave move and a 3-wave move back. If it fits our retracement of at least 50, 61.8, that would be the perfect retracement trade opportunity to short what is the beginning of a wave C. Right, so that concludes the new count I presented here on the Dow. Like I said, it's still an idea, formative idea. I just measured everything first, found those confluent levels of fib retracements and extensions to be very compelling, and then worked on the idea that this is just a zigzag into a wave B. So I would be very interested in hearing your comments. So if you're new to the channel, please subscribe, smash the like, let us know what you think in the comment section below if you want to. Feel free to share it in these videos, and take care guys. I'll be back with you hopefully later today with another couple of videos, but I am really pushed this weekend, so I'll do the best I can. Take care, all the best, speak to you soon.